Hello, welcome to this is gonna be lecture 5, yeah, and we're still gonna be looking at working capital management. Remember this formula where we said the asset can be financed by asset, by liability, or equity, or both, right? And we're still gonna be looking at this formula. Assets is broken down into non-current assets and current assets, yeah, and the part we've been talking about so far in this series is current asset, right? So, which is made up of things like cash, inventory, and account receivable. Yeah. So, what we'll be doing now is to start picking any of this working capital item, and we'll start looking at how to manage them and why do we have to manage them. That is the question we must answer for each of these items. So today I will look at account receivable in this video. How do we manage account receivable? First of all, I will explain what is account receivable. I'll do a reminder on that. I'm sure most of you listening to these videos will know, so I won't take so much time on that. But why do we need to manage it? Why? And how do we manage it? Those are the 3 questions that we must answer in this video. What is account receivable? Account receivable is when a company sells on credit. It's as simple. You've sold an item, so you have sales, but you've not collected cash. So you have sales without cash. Yeah, so you've transferred the risk and rewards to the customer who bought goods, but the customer has not paid. So in that case, in financial accounting, we'll say you debit account receivable for such transaction and you credit sales, right? So account receivable is coming as a result of sales without collection of cash. That's the definition of account receivable. But now let's go into the meat of this discussion. Why do we have to manage account receivable? And that's $1 billion question that have to be answered. And the major reason is just that because we want to minimize the cost associated with account receivable. We want to minimize that cost. And the next question you should be asking me is, what are those costs that are associated with account receivable? Are there any of such costs? Yes, there are costs associated with account receivable. And I will list them out for you. And you'll see. The first one is the finance cost. I will explain each of these costs one after the other. There's finance cost associated with account receivable. There is bad debt cost. And there's administrative cost, or I call admin cost. Let me explain each of these items, starting from the easiest one, which is admin cost. So admin cost is just the cost you have to pay your staff who are saddled with the responsibility of ensuring that customers pay their debt as early as possible. So you have these people you call account receivable staff or account receivable department. And all they do is to invoice customers and follow up on those invoices to ensure that those money are collected on time. Those staff will definitely collect salary. So they will not do it on free, right? And because of that, as a company, their staff salary, their transport, whatever they spend in trying to make that dream come true for their company, collecting that cash from their customers as quick as possible, all of that will be grouped into what we call the admin cost. Now, that's that. Bad debt is just the fact that when you are expecting to collect anything from anybody, be it money or any other asset, there is a risk of default. What does that mean? I'm saying there's a possibility that you might not be able to collect that money back from that customer or from that person, because so many things can happen. You don't know what's going to happen in two hours time, 1 day, 2 days, 1 month, in a year. Anything can happen, right? This guy can die, and that's the end. He can run away. The company can also fold up. A lot of problems. Yeah. So you cannot just expect that because the guy is owing you, is going to pay you. You are not going to have that 100% assurance. You don't have the certainty that you're going to be able to collect your money back. So because there's that risk of default, most times, not all account receivables are being paid. And some of them will end up being bad debt. Yeah? So because of that, this group of customers who have refused to pay us will give us an expense into our PIR, because at a point you have to write it off into profit and loss account as an expense, and that cost is called the bad debt cost because it's going to erode your profit, right? And that is why you have to be conscious of your account receivable and who you give credit to. Okay, yeah, so that is a bad debt cost. The third one is the finance cost, which is a bit technical one. So remember, the admin cost is the staff salary you are paying to your account receivable department. The bad debt cost is the amount of account receivable you are writing off into P&L because your customers would not be able to pay. But finance cost is slightly different, and I'm taking it as the last one because it's a bit technical, right? Finance cost is just talking about the fact that when you sell, take for instance, you sell 100 million sales, right? And you make all those sales on credit. So you also have 100 million receivable. So you have that amount sitting in your account receivable. The truth is, your business must go on. Business must continue. You cannot say because somebody is owing you, you are not going to buy more inventory. Yeah, you still have to, right? You still have to buy raw materials. You still have to pay your staff. You still need to pay your vendor. You need to do all of that. And because of that, every time you sell on credit, you have to source for funding somewhere else. So you have to source for funding. And that funding in this paper is what we call overdraft. So every time you have account receivable, your assumption is that your account receivable balance must be financed with same amount of overdraft, with same amount of overdraft. So which means in this scenario that I painted earlier, you would also need 100 million overdraft to run the business. And that is the assumption, right? If you have overdraft, I don't know whether you understand that banks would never give overdraft free of charge. They will give overdraft with cost. Overdraft will come with interest expense. It's just the same thing as collecting loans, right? So if you collect 100 million overdraft, at the same time, you will have to pay interest on that 100 million if you are using the overdraft. Okay? So very important to note that if overdraft rate is take for instance at 5%, yeah, which usually you will be provided in a question. Your finance cost in this regard will be calculated as 5% of the account receivable, which is 100 million. And that means you're going to have $5 million as overdraft. So, and when we start doing more questions, which I will use one video to do, you will see how all of these costs will play a role in what we're doing, because you must be able to calculate each of these costs for you to be able to decide how best the company should manage its account receivable. But don't forget where we're coming from. We said we're going to look at account receivable in 3 categories. What is account receivable? Why do we need to manage account receivable? And how do we manage account receivable? And that is where we're going now. How do we manage account receivable? Now we know why we have to manage account receivable. We have to manage it because we want to minimize the cost as much as possible. But how do we do that? How do we do that? It's good to have good intentions, but it's not good enough not to know how to make it a reality. How do we make that a reality? And I'll break down into 2 categories as well, so that it's easy for you to remember. The first category is, what do you need to do before you even give that credit? So before credit, what do you need to do? Yeah? You agree with me that it's quite cheaper to prevent than to cure, right? So, and another way, in Africa, they say that prevention is even better than cure, right? So it's just so obvious. Like, if you want to get the best from whatever you're doing, if you don't want to spend money so much on trying to cure a problem, just prevent it. It's always easier to prevent it. The cost of prevention is much, much less than the cost to cure, right? And even your health, you do exercise, you feel better. But if you wait until you're sick, you're going to spend a hell out of money to get better in the hospital, right? So let's look into what you need to do before giving credit. 2 major things you have to do. The first one is to assess the credit worthiness of your potential customer. Credit worthiness. So what are we saying here? What I'm saying here is, like, you need to assess your customer credit worthiness. Sometimes my brain thinks faster than I'm writing, so I'm already somewhere. So just let me take it slowly. Credit worthiness. Yeah, and what we're saying here is, you need to know your customer. You need to know, what are they doing? What is the nature of their business? What should you be giving? Should you even have business with this type of customer? Is the business of your customer even legitimate? Is your business of your customer, is it even profitable? Are they doing well? Are they entitled to this credit? So you need to be able to assess what is their credit score. If you're talking about individual customers, even if you're talking about companies, what is their rating? What is their credit rating? Is it A plus? Is it double A? Is it triple A? You need to do all those assessments. When you have all of that, and good, there are a lot of companies that do those assessments, and you see the result, right? So when you have that credit worthiness checked, and you feel like this person or this company has the right credit status to be granted credit, then the next question is, how much should I be giving you? So which means you also need to introduce what we call the credit cap or credit limit. So the fact that you have good credit worthiness doesn't mean that I can give you $1 billion. Some people have good credit, but when you check their credit capacity, which is what your credit limit will give you, you will know what is their capacity, what can they service, what can you give them that you will not have to cry, you will not have to fold up before you can get your money back. And that is where the credit limit comes into. So it's about knowing the capacity of your customers. You need to know their credit capacity. So if you do these 2 things, most likely you won't have too much problem with after credit, which is the second group that I want to look at. So how do you manage your account receivable after you've advanced credit to these customers, which means you have sold to the customers. These customers have departed with your goods or service. Then how do you get your money back? The first thing is, you must invoice immediately. Don't delay. The delay might be dangerous. So you have to invoice immediately. And that is not even sufficient. After you have invoiced immediately, you need to follow up promptly. So prompt follow up. Yeah, especially when the payment is due, right? So sometimes you give 10 days, 30 days, 60 days based on your agreement with your customers. But you invoice immediately so that those days can start counting instantly after you sell. But at the same time, you need to follow up, especially if the customers have not paid even after the due date. So very important. If all of that fail, then you might also want to consider what we refer to as early settlement discount. And we will see this in calculation in subsequent video. Yeah, early settlement discount is just saying, like, you want to give some incentives to your customers to say, yes, I know our agreement is that you will pay me in 30 days, but you know what, if you can try and do better than that, beat our target, pay within 10 days. If you can pay within 10 days, I'm going to give you some money back. I'm going to give you some discount back. So you are owing me $100 million, but if you can pay me in 10 days, just pay me 90% of that money. So you are telling your customers that you are ready to give them some discount if they can pay earlier than agreed. So remember, the catch here is that the customer will pay earlier than agreed, because usually there are agreed number of days for payment. But if the customers will not be willing to pay earlier than that, yeah, you give them a discount. It comes at a cost as well. And sometimes you want to weigh your cost and see which one is better. Do you want to incur those three costs we mentioned, the admin cost, the bad debt cost, the finance cost, at the expense of early settlement discount? It all depends on which one is better, and that's what we'll see when we get into calculation, because then we'll be doing some cost benefit analysis. And the last one here that I'm going to mention is factoring. Factoring is just collection agent. Yeah, that's a fancy word. It's just a collection agent. Right. So these guys, they are just so experienced in collection. Wherever you go into, they will find you out. If you like, travel to Australia, go to New Zealand, go to wherever you want to hide, go to Atlantic Ocean, they're going to bring you out and you're going to have to pay that money. But they won't do that service free of charge as well for the company. So they are pretty expensive, but you are almost sure that you will most likely get your money back, right? But everything comes with cost and benefit. So these are the things you need to weigh before you decide how you want to go as a company. Because like I said, for early settlement discount, it comes at the cost of the discount. Yeah. Likewise, factoring comes at the cost. So the agent will charge you. The factor agent is going to charge you. So usually there's a factor fee. Yeah. So if I call it disadvantages, yeah, or cost of factoring, there's factor fee, which usually is expensive. Also, customers might be irritated because the way factors will chase customers, they might not even want to. The customers might not want to come to you to buy goods again, because the customers might be irritated badly by the factor agents. Yeah. So sometimes the factor might also put as part of the condition that the financing of your receivable will now be handled by the factor. And usually, if you allow them to do that, I bet it's going to come at a cost that is even more expensive than what you were getting from your overdraft. So that might be a challenge. And also, because of the way they handle their collection, your reputation might be at risk as a company. Because if all customers believe that when they are owing you, you're going to send some wicked factors to them, yeah, then it's a problem. Yeah, so your reputation might be at risk. So you won't like that. Yeah. Imagine if you have a factor that is giving you poor customer service. That is, I mean, your customers are having issues with them. Yeah. Your potential is already limited. I'm not sure how far you will go as a company. So you don't want to get to a point where you have to actually do factoring and even maybe too much follow-up. Yeah, because if you do these two items before properly, you do number three, you're probably going to be good, right? But sometimes there must still be some difficult customers, right? So that's how you manage your account receivable. And I think with that, I'll just mention for foreign account receivable, because you're going to be expecting to receive foreign currency. There are various methods you can use for that. You can use matching, which is offsetting account receivable and account payable. You can use for transactions as well, which I will discuss in detail when I dealing with a topic on risk management. But for now, I will leave it here, and in the next video, we'll look into how we manage inventory. Hope you enjoy this video, and if you do, please like, remember, and always share with your friends and colleagues.